Good day traders, what's going on? This is Prof from bencovforex Academy speaking. I want to welcome you back to the channel. If you are a new subscriber, make sure you hit that subscribe button and turn your notifications on so that you don't miss any of the content that we'll be uploading on this channel. On this channel, guys, we talk about the Elliott wave, we talk about PTMM, we talk about ICT, we talk about order blocks, we talk about market structure, everything you need to know. If you haven't watched my videos on market structure, make sure you go through the videos. They are here on the channel. If you need to hear more about these concepts, you just contact me. You can contact me through the links that I've put in the description below. You can join my Telegram channel or my WhatsApp group, then you contact me, or even you can come through Facebook. Again, I'll assist you with everything that you need to know. So in this video, guys, I'm going to be talking about order blocks, everything that you need to know about order blocks. So I'm going to answer the following questions. I'm going to help you understand what an order block is. So the first question that I'm answering is, what is an order block? Then the second thing that we're going to talk about is, which order blocks should you trade? Which order blocks should you focus on? As we define an order block, we're going to see that there are various, or there are going to be many order blocks that you can see on your price chart. So the question is, which one is the best order block to trade, and which one should I concentrate on? Then the last thing that we're going to talk about, after you identify which order blocks to trade, I also want to help you build a strategy based on order blocks. So we're going to talk about how do you trade an order block, how then do you trade what we call an order block. So without wasting your time, guys, let's go to our chart and start explaining what is an order block. What is an order block? Okay, so an order block, if you are in a downtrend like this, I'm going to be using this chart to explain what an order block is. So if you are in a downtrend like this, you can see that the price is going down. If you're in a downtrend like this, when the market changes direction, like what happened here, what we call an order block is the last down close candle that you're gonna have on your prices. It is going down. You want to look at the last down close candle. So in this case here, I'm looking at my red candles. These are my last down close candles that we're talking about. So if I'm looking at this price chart, I'm just looking at the last down close candle. That last down close candle, or the red candle, is what I refer to as an order block. That is an order block. So the next question is, if this is an order block, why is this one not an order block and this one not an order block? So an order block is confirmed. Number one, how do you validate that this is now your order block that you're gonna be trading from? So an order block is validated when the opposite close candle, in this case my black candles, if it then goes and closes above that order block, when it is violated by an opposing close candle, in this case a bullish candle, then the order block is validated. That's what we call an order block. So basically, if we're going to summarize what we're talking about there, we are simply saying that an order block is going to be an area of interest. It's going to be that area where you look to take your trades. You're just using it as your point of interest and an entry point, and the conditions we're going to talk about them that you're going to be looking at for that to then for you to then use that as your entry. Don't worry, guys, I'll take you through everything. Just take a back seat and listen to what I'll be saying. I will help you through. So when we're talking about order blocks here, if I'm looking at these down close candles, because when you talk about order blocks, guys, we're talking about smart money, we're talking about supported moves. But whether the move is supported by banks or it's supported by institutions, financial institutions that have deep pockets, that have good money, we shall not ask the retailers whether it's supported by the robot. Whatever is supporting the move, what we're calling an order block, is a supported move. It is a supported move. So since it's a supported move and we're talking about blocks of orders, we're talking about volumes that has been traded. So when you look at an order block, if you look at this candle here, let me just use this candle as my order block here. If you look at this candle here, if you are going to mark this candle as your order block, guys, what you need to do is, obviously this candle has a high, it is an open, it is a high, it is a close, it is a low. What you then focus on is the body of the candle. What we are focusing on, guys, is the body of the candle, because we're talking about a supported move. We're talking about a block of orders. That's why it's an order block. So what we are simply looking at, guys, is we want to focus on the volumes of orders. So the volumes of orders obviously are going to be represented by the body of the candle. So when we're looking at our order blocks, we're going to be focusing on the body of the candle. We want to check the body of the candle itself. How big is the candle? And this order block, for it to be a reliable order block, for it to be more successful, for price to react at that order block later on, we need to see more orders. We need to see the body of the candle being bigger than the candles that are around. We need to see a big candle. That big candle is what we are looking into as our area of interest, there. So if we are going to be looking at the wicks of the candles, those will talk about the wicks of the candles. I'm going to talk about the wicks of the candle. All these wicks of the candles, I will talk about them when I talk about the concept of fair value gaps. When I talk about the concept of fair value gaps in prices, the voids that are left behind as prices running away from the order block itself. So ideally, a good order block should not see price trade through the mean threshold of that particular order block. If we're looking at this order block here, if you measure from the body, from the top of the body to the lowest point of the body, ideally what we are saying is, we're simply saying that price should not trade through and close below the midpoint of this candle. If it trades through and close below the midpoint of that particular candle, then that order block is, you need to suspect it will not be a good order block. So what we're simply saying there is, the price should not trade below the mean threshold of that particular candle. You need to watch price and make sure that the price does not trade below the mean threshold. The moment it trades below the mean threshold, guys, just know that the chances of that order block holding are then decreasing. So as we talk about these order blocks, I want to introduce a special kind of an order block. I want to introduce a special kind of an order block that I call a propulsion block. I want to talk about a propulsion block. So the question here is, what is this propulsion block? What is this propulsion block? So what I call a propulsion block is still a down close candle. Look at these candles, how they are arranged here. Allow me to just indicate this area so that you see what we're talking about. So if I'm in a downtrend like this, then I have this as my turning point, and then I'm given these candles going to the upside. Then candles come back to the order block, they retest the order blocks, then they start going up. As it starts going up, I'm going to have also these last down candles as my order blocks. We will talk about them when we are slicing price down to the lower time frames. So I'm going to have these as my order blocks as well. So what I call a propulsion block will be this red candle, this down close candle, that is now trading down to this order block. If you check this order block here, I'm going to take this candle and this candle as one order block. Why? Because the wick of this candle is covering the body of this candle, so it's as good as this is just one candle. That's a skill, guys, that you will develop as you continue to use these order blocks as your point of interest. Is as you go through your charts and backtest, you are going to see that in most cases it's important to consider these candles that will be engulfed by the wicks of this candle with a bigger body as just one candle. Why? Because the volumes that are encompassed here are also within the lowest point of this other candle. So what we call a propulsion block, we're talking about a propulsion block. If you check the behavior of this candle here that you're given here, it has traded down into these candles that we are referring to as order blocks. So a propulsion block is a down close candle, this down close candle that will then trade into these other order blocks. The moment it then trades into these order blocks, then price reacts from it. This now becomes our point of interest, the new order block. We call this a propulsion block. So as the price now comes back to this propulsion block, we are also saying that this propulsion block will be as sensitive as the order block that you'll be having here. So in other words, we're simply saying that this one also should hold as an order block, and the price again should not trade through the mean threshold of this order block. The mean of this order block should be very important. If you see price trading through the mean threshold of this order block that we are calling a propulsion block, then it means this propulsion block is not going to hold anyway. The probability of it holding then becomes very low. So you then need to use that information for your management of your trades. So that's a propulsion block, ladies and gentlemen. So let's just continue with our analysis there and talk about the second question that I had raised, to say then which order blocks now am I going to trade. Now you have told me that this is an order block. Now you're saying these are also order blocks and this is now an order block. So which order block now should I trade from? Which order block is the most important? Well, in answering that question, ladies and gentlemen, I'm going to talk about key points. I'm going to talk about different things that you need to consider when you are screening down your price, when you're looking at an area of interest which you're calling an order block. You then need to screen down your price and streamline it by identifying, number one, your key points, which is your support and resistance, where liquidity is. Where is your liquidity? Where are your orders? In other words, where are your orders? When you have a point, a swing high like this, when you have this point, then we are expecting that people who took this trade, they have their stop losses up there. That becomes liquidity that you can look into. So these points about liquidity and all that, I'm going to do a video on liquidity so that you understand what we call liquidity. So we are basically looking at your support and resistance. We are looking at liquidity. You are also looking at institutional support. Is your move supported by institutions? Is there an institution? Is there rapid movement from the order block? Is there rapid movement? You can see now that these are all black candles. They are all bullish candles that you given here, meaning to say that this move, indeed, even if you're not sure, you can see that this move, this is an H4 candlestick. So you can see that this move might really be supported by smart money. This is H4 time frame that I'm using here. So you can actually see that this move might exactly be supported by smart money there. Okay, that's H4 time frame that I'm using there. I'm just indicating so that you see that we are using H4 time frame there. This is higher time frame that we're using there. Okay, so it's step index and we're using H4 time frame right now. That's what we are looking at. So I was talking about how and which order blocks should you trade from. So I was saying that the first thing that you need to look at is your support and resistance. Where are your key areas? If you're using demand and supply, where are your supply areas? Where are your demand areas? If you're using the Fibonacci, where are your key areas? Where is your 78.6 retracement? Where is your 61.8 retracement? Where is your 32.8 retracement? Where is your 50% retracement? Where is the equilibrium? Where is a discount? Because remember, when you're looking at institutions, the institutions like to buy when the price is very low, so that when they get to higher points, they can release their orders and make a profit. They also like to sell when the price is very high, so that when they when it goes down, they can empty their orders. So that's what we are simply saying there. So let's talk about the next point there. The next point is you need to look for your fair value gaps. You need to look for fair value gaps in price. Those areas that have not yet been filled in price, you need to check those areas. So what is a fair value gap? What is a fair value gap? So when price is moving away from an order block, like in this case, you're going to see that there are going to be imbalances in price. When price is moving away like this in a very fast movement, here you can see that you only have black candles there, meaning to say that if you're just looking at it like this, there is a possibility that the price was offered on one side there, and if price was offered on one side, then what price would want to do is it would want to come back and also offer it to the other side. There were only buys in some areas and there were no sellers involved. So the price would want to come back and also balance that price, so that they are all saved. So in that case, now we are simply saying that the other side, let's just change this to silver so that you can see. So if you check here, you're going to see that if you check the wicks of these candles, this wick means that price was offered to the buy side, then it was also offered to the sell side. That's why we have that wick. It once was a bullish candle full of bullish momentum, then there was a bearish candle that was offered there. So it simply means that price was offered both sides. But if you then check here where I have indicated, you see that there is no wick there that is covering that area there. That's a fair value gap there. Price would want to come back and cover that fair value back later, fair value gap later. Even if you check here again, you're going to see that there is a wick for the red candle up to this point, but from the wick of this point up to the wick of that particular point there, you see that the price was offered again on one side. Those gaps is what you're looking at a higher time frame to then see where are your fair value gaps. Where you have those fair value gaps, you want to look at the points where the fair value gaps are going to end. Where the fair value gaps are going to end, do you have order blocks? Those order blocks that you have immediately after the end of the fair value gaps are also important. You need to consider them. You need to investigate them and see if price is going to react from that particular area. You also need to look at structure, guys. I made 3 videos now that I've posted. The 4th video I intentionally didn't post it because it's for my private student, but I made 3 important videos that is vital information about market structure. That's the other thing that you need to look at when you're deciding which order blocks to trade. It's very important, ladies and gentlemen, to consider your market structure. You want to look at market structure and see where price is going. Your order flow, where are the orders flowing to? Are we in a sell mode? Are we in sell mode? Are we in a downtrend, or are we in an uptrend? Are we going down in a downtrend? Where are your orders going? Or are we now in an uptrend? Where is the order flow going? Where is market structure going? That market structure is very important again when you're choosing which order blocks to trade. So here we can choose to trade these order blocks here and refine them and look at the best order block to trade that has not been tested before, to then look for price to come back to that particular order block. Why? Because we have seen that there is institutional support in this move. Price is moving rapidly from from this this area here. Let's just call it an area for now. We're going to reduce the order blocks to lower time frame so that you see here prices moved rapidly from this area here going to the upside, and you're also going to see, if you look at market structure, if you're using the Elliott wave, you're going to see that you have 1 2 3 4 1 2 3 4, and the fifth wave. If you then let me just mark it for you, for those who have not watched my videos on market structure, please make sure you do so. They will also help you understand which order blocks to trade. They will also help you understand which order blocks to trade. Let's just increase the size of those. Okay, I think now it's a bit clear. So you're going to see that you have your 1 2 3 4 5 waves, and at the end of this 5 wave, prices confirmed that it's now going upwards. If you have done your Fibonacci measurements there, like what I showed you in that market structure, in the third market structure video that I posted on this channel, you can go and check it out under market structure. You see that this was imminent. This was supposed to be a turning point according to those Fibonacci movements. What you were just waiting for is, even if you look at the internal structure 1 2 3 4 and 5, if you go and measure it again, it will also give you the measurements of those waves even on lower time frames, as you are going to see. So number one, you have seen that the move is supported. Number two, you have seen that this was a turning point for this according to another concept of the Fibonacci. Number three, you check your impulse and corrections and see that this is supposed to also go up. Number four, you can use the market maker to then see the number of levels that this has been falling, and if the levels are now enough for you, then you can also take the trade. So all those things, guys, are showing you where your point of interest should be, where your order block should be. Remember, order blocks are point of interest. They're directing you exactly in the area where you should take your trade before you start reducing these order blocks to lower time frames, so that you can take your trade with a small lot size. So the last question that I intended to answer, so I hope I have answered that question on which order blocks to trade. Which order blocks to trade? What you're simply looking at is those key elements. Number one, where is my support and resistance? Number two, where is my market structure? Does this move have institutional support? What am I using for my market structures? Is there Fibonacci levels that I need to look at? Is it an area of supply and demand? If that's what you're using for market structure, are my levels enough? Are my waves enough? That's what you're simply looking at there for you to decide this area of interest. So now let's continue with our analysis of order blocks. Now we want to talk about how then do you trade this order block. How best should you trade on an order block? Number one, what you need to know is your market structure. You need to have bias. You need to know sorry about that. You need to have bias. You need to know where the market is coming from and where the market is going. You need to know whether you're in an uptrend or you're in a downtrend. Don't try to pick highs and lows. Don't try to cheat the market. You never cheat the market. You need to be patient enough to then see where the price is going and where you are in your market structure. If you are in a downtrend like this, then obviously what we're looking for is bearish order blocks. And if you're in an uptrend like this, we're looking for bullish order blocks. And those bullish order blocks should be in areas of discount. They have to be very low. They have to be in low areas where institutions are willing to support that price. Whatever I'm telling you here works on volatility indices and also works on currencies. As long as there is a price action chart, this works, ladies and gentlemen. You can go and try it wherever you want. So number one, we have talked about the bias. which is the order flow, your market structure. You need to know where the orders are flowing to. You need to know your market structure. Then number 2 is you need to see the movement. You need to see that price is moving up. You need to see price taking out market structure. If I just look at this lower time frame wise, you need to see price breaking market structure, showing its willingness to go upside. In this case, I'm using this as my market structure. The price was making lower lows, but all of a sudden, let me just put a trend line there so that it's easier for some of my friends to see. But all of a sudden, price has immediately shown willingness to then start pushing to the upside. That's an indication that there is institutional support. So if I'm going to be trading on H4, I'm not worried about this movement that has happened here. If I'm going to be trading on H4, I'm not worried about this movement here. Why? Because this movement is going to confirm the point that I've just told you, that what you need to see is you need to see institutional support in the move. You need to see price moving away from where it has created order blocks. So this order block is these order blocks, let me call them these order blocks here, which are going to identify and agree on which one is going to be the order block you trade on. These order blocks here are the reason why you have this impulse up. So what you then do is you need to see this move before you can commit yourself and your money to taking that trade. Then the third point is price should come back to this order, to this area here that it has created here. So price should come back to these order blocks that it has created here to retest the important and the proper order block. It should come back to retest the proper order block in this area here, which we're going to do together. We're going to reduce these order blocks. Then I'll tell you which order block we are supposed to look at, where is our point of interest in all these order blocks. Remember, we have a propulsion block now and we have the original order block. So we're going I'm going to tell you which order block to trade from this information here that we have given by the price, from this price action. So the point that I'm explaining there is point number 3, where we are saying that the price should come back to the order block, to the area of interest that it has been created, where the move was supported. And as the price comes back to this area, it should come back in a corrective manner. It should come back accumulating more orders. It should not come back in a very fast it should take its time. It should accumulate more orders. It should accumulate more orders, so that when it gets to the point of interest where the price is moved off from previously, it will then also react from there. As price comes back to that area, the assumption is, and our belief is, that these institutions that have made these orders here, because the price has come back to a discount again, they will be willing to support that price again upwards. Then we join them. That's why this is smart money trading. As the price comes back to this area where these orders were before, then these people who have supported this move will be willing to support that move, will be willing to add more orders to the market. So we expect this move way before, because we know that this price was a key price. It was an institutional price. We just adjusted this to 90.30.5. So as this price come back here, these people, we were expecting it to come back. As long as it came back in a corrective manner, we then expect to take a trade there. How do you take the trade? The first thing that you can do is, if it depends now with your psychology. If you know that you are not going to take this trade because of fear, then you just have to put an order here on the open of this order block here. You're just going to put an order there and wait for price to hit your order, and then you have your stop loss below these lows. But now if you're going to take your order there, then you put your stop loss below these lows, we're on H4. Sometimes your account will not be big enough to then hold all this move down there. So what you then need to do is, after you identify your order block, we're talking about how do you trade an order block. Let me just identify these order blocks with you. So let's look at this as being the last down candle. We're going to start with this simple one first. Let's look at this being the last down candle that you're given here. So what I'm going to do is I'm going to switch to lower time frames. From H4 I'm going to go to H1. Okay, so this is the area where we were at, where I've indicated that order block. So that order block is represented here. So from this information here, what I then need to do is I need to identify which one is my order block. Which one is my order block from all this information. So we have agreed that what we call an order block is the last down close candle. Let me use this line. Is the last down close candle, which is the majority of the body of the candle. So if I look at these candles that I'm given here, the last down candle that I have is this one, and it is the majority of the body of the candle. It was, if I measure this body here, it's encompassing even all these other candles that are behind it. So this is going to be my order block here. So this order block, I want to, because I cannot have my stop loss down there, it's too big for me. My account is just maybe a $50 account. I would then need to reduce this to lower time frame. So I'm going to shift again to 15 minutes and reduce again this order block. So this is my 15-minute time frame now. So on this 15-minute time frame again, what am I looking at? I'm looking for the last down close candle, which is the majority of the body. The last down candle, which is the majority of the body. Allow me to pick another line there. So if I look at this candle here, I have two candles. I have this candle and this tweezer like looking candle. So which one am I going to pick as my order block? Number one, I need a body. I need volumes. Because I'm looking at institutional order flow, I need volumes. I need where most orders have been picked. So in this case here, this is where most orders have been picked. Now, if you check this candle that I'm making reference to, and you check the wick of this candle that I'm making reference to, you're going to see that even the body of this rejected candle is also engulfed by the wick of this particular candle. So I would treat this candle as one order block. So my order block there, I'm going to mark it here. So when you want to take your trade, sometimes some mentors advise you to then go on to lower time frames again on this order block to M5, then you reduce this to the lowest down candle that you'll be having, so that your stop loss is low. But if you do that, in most cases, I want you to go through your charts and see it for yourself. If you do that, you see that if you filter your order block in that case from this area here, you're going to see that in most cases you're going to be missing the trades, and that will lead to frustration, that will lead to you blaming the order blocks, that will lead to you leaving the order blocks. Well, it doesn't work, it's a scam and all that, when actually you're the one who is making too many mistakes. So what you do is you then want to see price going up. Remember, you want to see price going up, breaking structure. So here I'm on M5, I'm on M15. So I'm going to do the same thing that I've done on H4. So this is my trend line here. So what am I seeing? I'm seeing price, willingness of price to break structure. Not only breaking this structure that I've been given here. Let me just put, I want this to be my order block. So let me just put another line again. So this also is a high that has been broken. So I've broken this trend line, I've broken this high. So this price also have left some gaps, showing that there is support in this move. Whether it's supported by a robot or it's supported by institutions, I don't care. But what I know is there is support in this move. So what am I looking for now? I want price to come back. To come back where? To come back to my order block, my area of interest. Then when price comes back to my area of interest, I'll take the trade. So I want price to come back to the open of this candle, to this open where the body is starting. I want to put my order there. When I put my order there, I put my stop loss on the lows. I'm going to put my stop loss on the lowest lows, so that even if they're going to do stop, and remember what a good order block is. We said a good order block should not see price trade through the main threshold of that particular order block and close there. If it trades through the mean threshold, it should close above the mean threshold of that particular order block. So if I put my stop loss below these lows, I am assured that my stop loss will not be hit. If they hit my stop loss, then they are changing trend. Either they are continuing or they are changing trend. And you'll never be sure about that. But as long as they are going to close below, that's an indication that this is not a good order block. If you want to close the trade manually there, close it, and then you look for opportunities somewhere. Remember, we're working here with the probabilities, and we want to increase our chances of winning. So that's one way of trading it, just leaving your order there so that they come back to pin the orders and they go. Then the second way of trading, a more conservative way of trading the order block, is when price comes back to the open of the order block, you don't immediately place a trade. What you then do is you then need to see price rejecting the order block and showing willingness to go up. If it then rejects the order block and shows willingness to go up, what you then need to do is you want to see price breaking structure in the lower time frame. You then go to the lower time frame after it is testing. After it is tested here, you need to go to the lower time frame. If you're on M15, you go to the lower time frame now, and then you look for break of structure. In this case here, you're given this break of structure here. They broke the high, they came back to test the high and continue. And then after you have break of structure, you then need to identify the order block that led to that break of structure. In this case, which order block led to break of structure? Here I'm going to use this propulsion block. We'll talk about the propulsion block soon. So in this propulsion block is where now you need to put your on the open of the propulsion block, you put your orders there. Then if you're going to put your orders on the open of this propulsion block, then the stop loss now, because now this has been tested, the stop loss now should be below the order block that you have used. So the stop loss, you're not going to put it on the lows like in the first scenario of trading the order block, but in this case now you're going to put it just below the order block that you have used to take your trade. That's where you then put your stop loss there. This is a more conservative way of trading an order block, and this works on very much if you have a small account, like a $50 account, a $100 account, a $300 account. If you have a small account, then this should work best for you. So that's how you can trade an order block there. Where should your take profit be? If you're going to trade the order block in this way, depending now on your market structure, what is market structure telling you? What is institutional order flow telling you? Then the market structure will determine whether you're going to hold the trade or it's going to be a very short-term trade. But if you are a day trader or a scalper, you just need to target the immediate high or the next order block of the next opposing order block. In this case, you'll be targeting these order blocks here. Once you hit the order block, you are out. Once you hit the order block, you are out. Or you can target the swing highs, the swing points as you go up. This was the swing point that this order block left. So once you take out this swing high, you are out. But in this case here, you'll be using this order block. Once you hit the order block, you run away, you take your money. Okay, that's how best you can trade the order blocks. Now we're talking about the order block in general. Now I want to talk about the propulsion block. Remember, we introduced a propulsion block. I just want to explain what a propulsion block is. When we're talking about everything, we're using this area here in lower time frames because it has all the information that we wanted. So now we want to talk about a propulsion block. What is a propulsion block? We said a propulsion block is also a down close candle. If you're in a downtrend, it's going to be a down close candle that has traded into the order blocks and now is taken the role that the order block was supposed to play. So the role that the order block was supposed to play is it was supposed to be a best support price, so that this price, as it comes to this order block, it will then react. But now, because there is this propulsion block that is traded into the order block, this propulsion block will then take it will then act as an area of interest. It will then take it becomes our new order block because it has traded into this. So if I am going to be trading on H4 and I'm waiting for this price to come back to my area of interest, which is the order block, the best order block that I will then use is this last down candle before the uptrend. It is this last down candle before the uptrend. The last down candle that is traded into this order block, it must have traded the last candles that were going down. So the initial order block was this one. Then we have these trading into these initial order blocks, testing the order blocks. As the price was going up, it left another order block, which we are calling a propulsion block, because it traded into these other candles. This propulsion block now is where we expect the price to react. This propulsion block is where we expect price to react, and if we are going to trade this on H4, we just simply put our stop loss below the propulsion block, because if they trade through the mean threshold of the propulsion block and close below the mean, it then simply means that this is not a good order block to trade. Run away with your life. It's that simple. Don't be hopeful when you are trading. Trade the facts, trade the information that you are given with price. So that's it there. So now let's just look into this propulsion block and see how best you would have traded this propulsion block. So I'm indicating this propulsion block so that we go into lower time frames and also reduce this propulsion block so that we see where we are supposed to take our trade and also try to reduce the stop loss. So I'm going to shift again to H1 time frame. I'm now on H1 time frame. So on this H1 time frame here, I also want to identify the last down close candle. So if I'm identifying the last down close candle here, I have this as my last down close candle because this body is within this other candle. So this is my last down close candle. Then I need now to look at price. This order block was validated when this price traded opposing this order block. So it then validated this order block. But look at the next candles. What happened? The candles came back to trade into this order block. What do we call that? We call that a propulsion block. We call that a propulsion block. So if this is a propulsion block, then we need also to shift let's just shift our item there just a bit to the top so that we cover those propulsion block, these propulsion block. So if you check again, this one came back to trade again into this order block, which then made it a propulsion block again. So I'm moving this to this, but then this also came back and traded into this. So my propulsion block now is here. What am I doing, guys? I'm just refining my order blocks so that I don't miss the trade number one and I don't use the wrong order blocks to trade. I'm just refining them to lower time frames so that I don't use the wrong order blocks and I also don't miss the trade, because look, this takes time to develop. So if it's going to take time to develop, then I wait for it, then I miss it again, it's going to be very bad on my psychology. It's going to affect me psychologically. So what I want to do is I want to avoid missing those trades and make sure that I take those trades as they come. And then I'm going to shift here to M15 and also see how best we can reduce that order block. So this is the propulsion block that we have indicated here. This is the propulsion block that we have indicated. But look here what's happening. Look what's happening here. Which one is the last down close candle which caused break of structure of this? We have this as our last down close candle. This one here is our last down close candle there that we have. So if I'm going to use this, let's just change this and see if we're gonna be if we're gonna get that trade or not. If I'm going to use this as my entry point, then my stop loss should be just below this, because I've refined my order blocks there. I've refined my order. If then it comes below this, I'm out. It's not my trade. I'll look for another trade somewhere else. So this was going to be your entry point there. This was going to be your entry point. But look, it would have pinned you out where your stop loss was, or you would have been very close that you would have been pinned out. But this is how you refine your order blocks, so that you don't miss the trade. But the basic thing would have been what? Just put it on the open. Put the stop loss where it's supposed to be. Then you relax and wait. Let's just look at where the price is right now and see if you would have been able to take advantage of this trade here. So if we check the other side there, on the other side there is no price action from which to refer to. We are now down there. There is no price action to refer to. So you then need to make use of those market structures that I taught you in the other video, that I taught my student in the other videos that I posted on YouTube, that you can check out on market structure, how best you can understand market structure. In this case, you're going to see that impulse correction, impulse correction, impulse. How many levels? 1, 2, 3. If you're using Elliott wave, 1, 2, 3, 4, 5. So these are now 5 waves that you now have. So what are you expecting? You are expecting this to happen. You are expecting a reversal. So after, if we go to lower time frame, let's just go to lower time frame and see if we can get enough price action there. Lower time frame. Okay. 1, 2, 3, 4, 5. Okay, yes. All right. Okay. 1, 2, 3, 4, 5. All right. Interesting. So if I'm going to go to lower time frame there, I'm now on M30. This is what I'm seeing on M30. Price action is showing me this. This is what I'm seeing on price action there, given there in a clear broad daylight. So this is what I have on my price action chart there. So what do I have? Well, if you're using market, if you're using your Elliott wave, you're going to see that this is wave 5, and the wave 5 is now 5 waves. I'm going to explain that in other videos. You can check them out. Just make sure you have subscribed. So these are 5 waves to the downside. So if I have my 5 waves, or if I'm going to use patterns, you're going to see that let me check this out. Something like that. You're going to see that I had a trend line going to the downside. Day 1, 2, 3, but all of a sudden it has broken my trend line and it is showing signs of testing. So the moment I see a break of this structure, I have 1, this high that has been broken. Number 2, the trend line has been broken. The moment I see this, I want to look at the origin of the move. Where did the move originated from? So where the move would have originated from, I should get my order blocks there. It must be my area of interest. So in this case, you're going to see that all these candles are just an order block. Why? Because the wicks are covering the body of the last candles that you would want to label as order blocks. So all these candles here are just your order blocks. Then what happened? They came back to retest these order blocks. So now you have a new order block, this order block that you now have here. Okay, this order block that you now have here. So after you see price going up, what are you waiting for? You would want to see this price coming back correctively way to the order block. So what I'm simply looking for is, I'm looking to take my trade either here on the open of this order block. Then if I'm going to take my trade on this open of this order block, where is my stop loss? My stop loss should be on the highs, because number one, it's a break and retest of the trend line. It is broken, it's retesting the trend line. Number two, I have my point of interest there, I have my order block. I'll just need to put my my order there, then I put my stop loss below the low and relax. If they trade down there, it means it's not a good trade. I will look for opportunities somewhere else. That's number one of taking it. Number two of taking it, what did we say? We wait for price to come to the order block. That's number one. After price is now at the order block, what do we want to see? We want to see price going up and breaking structure in lower time frames. Let's go to the lower time frame. Here we are. So after prices come to the order block, we want to see price going up and breaking structure. What has been broken here? Price is broken structure there. After it is broken structure, let's go to M5. Yeah, this is now too much price action to look at. Yeah, right. After it is broken structure, what do you want to see? We want to see price going up to break structure. After it is broken structure on lower time frame, what do you want to do? You want to wait for the trade to come back to retest that structure which has been broken. If it comes back to retest that structure which has been broken, the order block which has led to that structure, then you join the trade. But look here, you would have missed the trade because you were waiting for M5 to then break structure. You were waiting for M5 to then break this high and come back to retest that. And remember, you also need to know that the broker knows this. The broker knows this. You need to trade smart. So this is everything I want to talk about on order blocks, guys. So in the next video, what I'm going to do is I'm going to talk about a special kind of order block that I call the mitigation block and the breaker block. Make sure you watch the second video that I'm going to post. It will be on mitigation block and what we call a breaker block. Thank you very much for watching.